So yesterday we saw about uh, the uh, last the role of self-discipline and how to think like a trader. The day before yesterday we started with that, and the author said about the different stages. One is the mechanical stage where you simply trade mechanically and following your trading system. The second one is the subjective stage where you do some analysis and you have to be very careful here. Third one is the intuitive stage where you automatically go to this particular stage intuitively. There is no rationality here. And the author wants us to have the consistent successful trader as the our core belief. And for this, we have to transform ourselves. And to transform ourselves, we have to start observing ourselves. And how we observe ourselves, we have to observe without any criticism. And once you do that, uh, then for that what you can do is you have to first observe yourself, and then author also asks us to reduce your position size in case if we are uh, unable to observe, get that self discipline and make it a mechanical manner, such way we will go to that zone. And uh, and the reason why the author is telling us not to criticize is that because those are all negatively charged energy, and as a result you will keep having that you know self denigrating thoughts which will basically harm you. Okay. And the author also, yesterday we started to read about the self discipline aspect, where the author says that whenever you are deviating from your objective of becoming a consistent successful trader, all you need to do is to gently move your focus towards that, right? So, and that is how you become consistently successful, right? And for that, you need to be little bit aware. And the author also said how he became a runner from normal walking, and by having some small hacks by which he became a runner. And once he became a runner, he no longer had to follow that self discipline. And for that, you have to have some beliefs which you have to tell it to yourself. So, and how to become that consistent winner belief is that you basically every time you tell that you are a consistent winner because you objectively define your edges. You predefine the risk of every trade. You completely accept the risk, or I am willing to let go of the trade. I act on my edges without reservation or hesitation. I pay myself as the market makes money available to me. I continually monitor my susceptibility for making errors. I understand the absolute necessity of these principles of consistent success, and therefore I never violate them. Okay. So these 7 points we have to tell it to ourselves. Now, these 7 principles are very important that we have to follow it to become a consistently successful trader. And if you do all these things, we will avoid all these trading errors of jumping the gun, hesitating, not predefining your risk, defining your risk, and but refusing to take the stop loss, and making it a much more bigger loser, or getting out of a winning trade too soon, or not taking any profits out of a winning trade. Okay. So these are all the things, right? And the author also said that for this, you have to have that desire and willingness to refocus on the object of your desire. So this desire is actually a force which we have to develop, right? And this and for this, the author is now going to come to this main aspect of the exercises which we need to do to follow those 7 principles which we will read today. Okay. So Exercise. Learning to trade an edge like a casino. The objective of this exercise is to convince yourself that trading is just a simple game of probabilities, numbers, not much different from pulling the handle of a slot machine. At the micro level, the outcomes to individual edges are independent occurrences and random in relationship to one another. At the macro level, the outcomes over a series of trades will produce consistent results. So in this exercise, the author is going to tell that, we are going to trade as a game of probabilities. Okay. And so just like, it is a random opportunity. So at the micro level, it will be like, uh, they are, independent occurrences and random to each other. But at the macro level, there will be some consistent results. From a probabilities perspective, this means that instead of being the person playing the slot machine as a trader, you can be the casino if you have an edge that genuinely puts the odds of success in your favor. You can think about trading in the appropriate manner, the 5 fundamental rules, and you can do everything you need to do over a series of trades. So the author is now telling that, instead of uh, uh, thinking like a trader, you have to think like the casino, and the casino always wins, right? So you have to put the probability, the edge, towards the odds of success in your favor, and so you have to think in those 5 fundamental truths that we have learned earlier, and all these things we have to keep on doing over a series of trades, right? So then, like the casinos, you will own the game and be a consistent winner. So the first one is setting up the exercise. Pick a market. Choose one actively traded stock or futures contract to trade. It doesn't matter what it is, as long as it is liquid and you can afford the margin requirements for trading at least 300 shares of 3 futures contract per trade. Okay. Choose a set of market variables that define an edge. This can be any trading system you want. A trading system or methodology you choose can be mathematical, mechanical, or visual based on patterns in price charts. It does not matter whether you personally design the system or purchase it from someone else. Nor do you need to take a long time or be too picky trying to find or develop the best or right system. This exercise is not about system development and it is not a test of your analytical abilities. In fact, the variables you choose can even be considered mediocre by most traders' standards because what you are going to learn from doing this exercise is not dependent upon whether you actually make money. If you consider this exercise an educational expense, it will cut down on the amount of time and effort you might otherwise expend trying to find the most profitable edges. Okay. So for those of you who might be wondering, I'm not going to make any specific recommendations about what system or variables you should use because I assume that most of the people reading this book are already well schooled in technical analysis. If you need additional assistance, there are hundreds of books available on the topic as well as system vendors who are more than willing to sell you their ideas. However, if you have made a genuine attempt to do this on your own, but are still having problems picking a system, you can contact me at markdouglas.com or tradinginthezone.com and I will make some recommendations. Whatever system you choose to use has to fit within the following specifications. So the first one, author is telling that, pick a market and where you can actually buy at least, three lots. Okay. So you should have that much amount of money and it should be liquid also. The next one is you have to choose a system, right? And you can choose any system, trading system, but the author is telling it is very readily available. The third one, the trade entry. The variables you use to define your edge have to be absolutely precise. System has to be designed so that it does not require you to make any subjective decisions or judgments about whether your edge is present. If the market is aligned in a way that conforms with the rigid variables of your system, then you have a trade. If not, then you don't have a trade, period. No other extraneous or random factors can enter into the equation. Okay. So every time you make a trade, only if it is, in alignment with the system. Okay. So there should not be any, judgments or subjective decisions of whether the edge is present or not. Okay. If the market is aligned in a way that conforms with the rigid variables of system, then you have a trade. If not, there is no trade. So there is a trade or no trade. That's it. You follow the trade system. Stop loss exit. The same conditions apply to getting out of a trade that is not working. Your methodology has to tell you exactly how much you need to risk to find out if the trade is going to work. There is always an optimum point at which the possibility of a trade not working is so diminished, especially in relationship to the profit potential, that you are better off taking your loss and getting your mind clear to act on the next edge. Let the market structure determine where this optimum point is rather than using an arbitrary dollar amount that you are willing to risk on a trade. Okay. So if it is not working, you have to exit the trade, right? And for this, your methodology has to tell how much you need to risk. Okay. So at one particular point, the trade will tell that, it is not going to work in your direction. And it is better to take the loss and get our mind clear than to behave on the next stage, right? So let the market structure determine where this optimum point is rather than using an arbitrary dollar amount that you are willing to risk on a trade. Okay. So the author is telling that, uh, let the market structure tell what you're going to lose. Okay. In any case, whatever system you choose, it has to be absolutely exact, requiring no subjective decision making. Again, no extraneous or random variables can enter into the equation. Okay. So whatever the trading system says that this is your stop loss, just exit it. Time frame. Your trading methodology can be in any time frame that suits you, but all your entry and exit signals have to be based in the same time frame. For example, if you use variables that identify a particular support and resistance pattern on a 30-minute bar chart, then your risk and profit objective calculations also have to be determined in a 30-minute time frame. Okay. So if we are And however, trading in one time frame does not preclude you from using other time frames as filters. For example, you could have as a filter a rule that states you are only going to take trades that are in the direction of the major trend. There is an old trading axiom that the trend is your friend. It means that you have a higher probability of success when you trade in the direction of the major trend, if there is one. In fact, the lowest risk trade with the highest probability of success occurs when you are buying dips in an uptrending market or selling rallies in a downtrending market. To illustrate how this rule works, let us say that you have chosen a precise way of identifying support and resistance patterns in a 30-minute time frame as your edge. The rule is that you are only going to take trades in the direction of the major trend. A trending market is defined as a series of higher highs and higher lows for an uptrending market and a series of lower highs and lower lows for a downtrending market. The longer the time frame, the more significant the trend. So a trending market on a daily bar chart is more significant than a trending market on a 30-minute bar chart. Okay. Therefore, the trend on a daily bar chart would take precedence over the trend on the 30-minute bar chart and would be considered the major trend. To determine the direction of the major trend, look at what is happening on a daily bar chart. If the trend is up on daily, you are going to look for a sell off or retracement down to what your edge defines as support on the 30-minute chart. That is where you will become a buyer. On the other hand, if the trend is going down on the daily, you are going to look for a rally up to what your edge defines as a resistance level to be a seller on the 30-minute chart. The objective is to determine in a downtrending market how far it can rally on an intraday basis and still not violate the symmetry of the longer trend. In an uptrending market, your objective is to determine how far it can sell off on an intraday basis without violating the symmetry of the longer trend. There is usually very little risk associated with these intraday support and resistance points because you don't have to let the market go very far beyond them to tell you the trade is not working. Okay. So here the author is telling that you have to choose a time frame and always choose a bigger time frame to find the trend and mark your support and resistances and use the smaller time frame to make your entry. So, for example, if the bigger time frame in, if for example, if we are trading in a 30-minute time frame, author is telling that choose a 1-day time frame, and if the 1-day daily time frame chart is going up, it is actually a so somewhere when the 30-minute chart comes down, you will make a buy. So that is your buyer. And similarly, when it is if it is going up somewhere at the top resistance, where you will go and sell, that is what you will do. So the objective here in this case is when it is downtrending, how much it can go down, okay, and also not violate the trend behavior. Or in uptrending market, you have to analyze how much it can go up and why not violate the trending behavior. Okay, so this is where you have to make the trade. Taking profits. Believe it or not, of all the skill one needs to learn to be a consistent, successful trader, learning to take profits is probably the most difficult to master. A multitude of personal, often very complicated psychological factors, as well as the effectiveness of one's market analysis, enter into the equation. Unfortunately, sorting out this complex matrix of issues goes way beyond the scope of this book. I point this out so that those of you who might be inclined to beat yourselves up for leaving money on the table can relax and give yourselves a break. Even after you have acquired all the other skills, it might take a very long time before you get this one down pat. So don't despair. There is a way to set up a profit taking regime that at least fulfills the objective of the fifth principle of consistency. I pay myself as the market makes money available to me. If you are going to establish a belief in yourself that you are a consistent winner, then you will have to create experiences that correspond with that belief, because the objective of the belief is winning consistently. How you take profits in a winning trade is of paramount importance. So here the author is telling that it is very difficult to tell when to take profits, and but the author is telling that you have to, if you have to be a consistent winner, then you have to create experiences that correspond with that belief. And so because the object of the belief is you have to winning consistently, and how you take the profits in a winning trade is of paramount importance. This is the only part of the exercise in which you will have some degree of discretion about what you do. The underlying premise is that in a winning trade, you never know how far the market is going to go in your direction. Markets rarely go straight up or down. Many of these NASDAQ internet stocks in the fall of 19 were an obvious exception to the statements. Typically, markets go up and then retrace some portion of the upward move, or go down and then retrace some portion of the downward move. So these proportional retracements can make it very difficult to stay in a winning trade. You would have to be an extremely sophisticated and objective analyst to make the distinction between a normal retracement when the market still has the potential to move in the original direction of your trade, and a retracement that is not normal, when the potential for any further movement in the original direction of your trade is greatly diminished, if not non-existent. So so far the author is telling that taking profits, we have to use our discretion. He's leaving it to us discretion, right? And because the problem is you don't know till when the market will go, and you don't know when it will retrace, and whether it is a real retracement or it is a change of direction, that is going to be very difficult, and you have to be extremely sophisticated to analyze. And okay, if you never know how far the market is going to go in your direction, then when and how do you take the profits? The question of when is a function of your ability to read the market and pick the most likely spots for it to stop. In the absence of an ability to do this objectively, the best course of action from a psychological perspective is to divide your position into thirds or quarters and scale out the position as the market moves in your favor. If you are trading futures contracts, this means your minimum positioning for a trade is at least 3 or 4 contracts. For stocks, the minimum position is number of shares that is divisible by 3, so you don't end up with an odd lot order. Here's the way I scale out of a winning position. When I first started trading, especially during the first 3 years, I would thoroughly and regularly analyze the results of my trading activities. One of the things I discovered was that I rarely got stopped out of a trade for a loss without the market first going at least a little way in my direction. On average, only one out of every 10 trades was an immediate loser that never went in my direction. Out of the 25 to 30% of the trades that were ultimately losers, market usually went in my direction by 3 or 4 ticks before repricing and stopping me out. I calculated that if I got into the habit of taking at least third of my original position off every time the market gave me those 3 or 4 ticks, at the end of the year, the accumulated winnings would go a long way towards paying my expenses. I was right. To this day, I always, without reservation or hesitation, take off a portion of a winning position whenever the market gives me a little to take. How much that might depends on the market. It will be a different amount in each case. For example, in Treasury bond futures, I take a third of my position off when I get 4 ticks. In the Standard and Poor futures, I take a third off for a profit of 1.5 to 2 full points. In a bond trade, I usually don't risk more than 6 ticks to find out if the trade is going to work. Using a 3 contract trade as an example, here is how it works. If I get into a position and the market immediately goes against me without giving me at least 4 ticks first, I get stopped out of the trade for an 18-tick loss. But as I have indicated, this doesn't happen often. More likely, the trade goes in my favor by some small amount before becoming a loser. If it goes in my favor by at least 4 ticks, I take those 4 ticks on one contract. What I have done is reduce my total risk on the other 2 contracts by 10 ticks. If the market then stops me out of the last 2 contracts, the net loss on the trade is only 8 ticks. Okay, so basically I think this is what you call as pyramiding. So you, as and when you get those, you reduce your, exit one quarter, the next other quarter, and like that. So even if it goes against you, you will have some profits which will reduce your loss. If I don't get stopped out on the last 2 contracts and the market moves in my direction, I take the next third of the position off at some predetermined profit objective. This is based on some longer time frame support or resistance or on the test of a previous significant high or low. When I take profits on the second third, I also move the stop loss to my original entry point. Now I have a net profit on the trade regardless of whatever happens to the last third of the position. So what he's telling is that obviously he's just moving his stop loss. After exiting the first part and the second part, he moves the stop loss to his original entry level so that, he at least, but if he reaches the target there also, he will exit. This is what author is doing. And in other words, I now have a risk-free opportunity. I cannot emphasize enough, nor can the publisher make the words on this page big enough to stress how important it is for you to experience the state of risk-free opportunity. When you set up a situation in which there is a risk-free opportunity, there is no way to lose unless something extremely unusual happens, like a limit up or limit down move through your stop. If under normal circumstances, there is no way to lose, you get to experience what it really feels like to be in a trade with a relaxed, carefree state of mind. Okay. So once he has exited the first two, obviously he's now in a risk-free, right? So he's like, he can exit, he can now, there is no way he's going to lose. Okay. So this is what you call it as a carefree state of mind. Okay. To illustrate this point, imagine that you are in a winning trade. The market made a fairly significant move in your direction, but you did not take any profits because you thought it was going to even further. However, instead of going further, the market trades all the way back to your very close to your original entry point. You panic and as a result liquidate the trade because you don't want to let what was once a winning trade turn into a loser. But as soon as you are out, market bounces right back into what would have been a winning trade. If you had locked in some profits by scaling out, putting yourself in a risk-free opportunity situation, it is very unlikely that you would have panicked or felt any stress or anxiety for that matter. Okay. So the author is telling that, if it had gone to some position, exit some of your positions, right? And because what will happen if it comes back to your position, we will panic and we'll be like, we lost whatever we could have made, right? So something like that. So this is what the author is telling here. I still have a third of my position left. What now? I look for the most likely place for the market to stop. This is usually a significant high or low in a longer time frame. I place my order to liquidate just below that spot in a long position or just above that spot in a short position. I place my orders just above or just below because I don't care about squeezing the last tick out of the trade. I have found over the years that trying to do that just is not worth it. Okay. So don't try to, so you have some target. So don't try to, always squeeze it till the end. Little bit, uh, place it below. It's okay to, you know, let it loose. Don't, so if you try to squeeze it, it will not, there is a probability of it not reaching. One other factor you need to take into consideration is your risk to reward ratio. Risk to reward ratio is the dollar value of how much risk you have to take relative to the profit potential. Ideally, your risk to reward ratio should be at least 3:1, which means you're only risking $1 for every $3 of profit potential. If your edge and the way you scale out of your trades give you a 3:1 risk to reward ratio, your winning trade percentage can be less than 50% and you will still make money consistently. Okay. A 3:1 risk to reward ratio is ideal. However, for the purpose of this exercise, it does not matter what it is, nor does it matter how effectively you scale out, as long as you did do it. Do the best you can to pay yourself at reasonable profit levels when the market makes the money available. Every portion of a trade that you take off as a winner will contribute to your belief that you are a consistent winner. All the numbers will eventually come into better alignment as your belief in your ability to be consistent becomes stronger. So trading in sample size. So author is suggesting that you make at least a 3:1 risk to reward, and you have to basically pay yourself at the profit, and whenever the market is making your money available, and basically you actually that is what author is trying. If 3:1 is something the author is suggesting. A typical trader practically lives or dies on the results of the most recent trade. If it was a winner, he will gladly go to the next trade. If it wasn't, he'll start questioning the viability of his hedge. To find out what variables work, how well they work, and what does not work, we need a systemic approach, one that does not take any random variables into consideration. This means that we have to expand our definition of success or failure from the limited trade by trade perspective of the typical trader to a sample size of 20 trades or more. Okay, so we have to take at least 20 trades. We have to back test. That is what author is trying to tell, and you have to try it out. Any edge you decide on will be based on some limited number of market variables or relationships between those variables that measure the market's potential to move either up or down. From the market's perspective, each trader who has the potential to put on or take off a trade can act as a force on price movement and is therefore a market variable. No edge or technical system can take into consideration every trader and his reasons for putting on or off a trade. As a result, any set of market variables that defines an edge is like a snapshot of something very fluid, capturing only a limited portion of all the possibilities. Okay. So here the author is telling that you have to have some variables which you will basically decide your edge, right? And because each and every trader is going to act as a force, therefore each trader is going to behave as a market variable, right? And so that is no edge or technical system can take into consideration every trader and his reasons for putting on and off a trade, right? And the set of market variables that define an edge is like a snapshot of something very fluid, capturing only a limited portion of all the possibilities. So actually, just more of the volume here. And this in this part, the author is trying to tell about the importance of volume. Right. So when you apply any set of variables to the market, they may work very well over an extended period of time. But after a while, you may find that their effectiveness diminishes. That's because The underlying dynamics of the interaction between all the participants is changing. New traders come into the market with their own unique ideas of what is high and what is low, and other traders leave. Little by little, these changes affect the underlying dynamics of how the market moves. No snapshot can take these subtle changes into consideration. You can compensate for these subtle changes in the underlying dynamics of market movement and still maintain a consistent approach by trading in sample sizes. Your sample size has to be large enough to give your variables a fair and adequate test, but at the same time small enough so that if their effectiveness diminishes, you can detect it before you lose an inordinate amount of money. I have found that a sample size of at least 20 trades fulfills both of these requirements. So you have to keep testing, back testing or front testing. And he says that 20 trades, you will know whether your trade is going to work, your system is going to work or not. Testing. Once you decide on a set of variables that conform to these specifications, you need to test them to see how well they work. If you have the appropriate software to do this, you are probably already familiar with the procedures. If you don't have testing software, you can either forward test your variables or hire a testing service to do it for you. If you need a recommendation for a testing service, contact me at markdouglas.com or tradinginthezone.com for a referral. In any case, keep in mind that the object of this exercise is to use trading as a vehicle to learn how to think objectively in the market's perspective, as if you are a casino operator. Right now, the bottom line performance of your system is not very important, but it is important that you have a good idea of what you can expect in the way of a win to loss ratio. Number of winning trades relative to the number of losing trades for your sample size. So the author is telling that, you do the testing. There are a lot of testing softwares. Back testing is available. Even in TradingView, it's available. You have to do some back testing. And for that, we can learn how it is there, how to do back testing in YouTube and all. But you do it and ensure that it is working. Accepting the risk. A requirement of this exercise is that you know in advance exactly what your risk is on each trade in your 20 trade sample size. As you know, knowing the risk and accepting the risk are two different things. I want you to be as comfortable as possible with the dollar value of the risk you are trading in this exercise. Because the exercise requires that you use a 20 trade sample size, the potential risk is that you will lose on all 20 trades. There is obviously the worst case scenario. It is likely an occurrence as that you will win on all 20 trades, which means it isn't very likely. Nevertheless, it is a possibility. Therefore, you should set up the exercise in such a way that you can accept the risk of losing all trades. Okay. So here the author is trying to tell that when you are doing these 20 tests of this particular system, ensure that you are accepting the risk, because all the 20 times you might actually lose. So and so that ensure that your position size, the how much lots, how much you are buying in that particular things, ensure that it is not eating up your entire capital. For example, if you're trading Standard and Poor futures, your edge might require that you risk 3 full points per contract to find out if the trade is going to work. Since the exercise requires that you trade a minimum of 3 contracts per trade, the total dollar value of the risk per trade is $2,050 if you use big contracts. The accumulated dollar value of risk if you lose on all 20 trades is $45,000. You may not be comfortable risking $45,000 on this exercise. If you are not comfortable, you can reduce the dollar value of the risk by trading Standard and Poor mini contracts. They are 1/5 the value of the big contract. So the total dollar value of the risk per trade goes down to $450, and the accumulated risk of all 20 trades is going to be $9,000. You can do the same thing if you're trading stocks. Just keep on reducing the number of shares per trade until you get to a point where you're comfortable with the total accumulated risk for all 20 trades. What I don't want you to do is change your established risk parameters to satisfy your comfort levels. If based on your research, you have determined that a 3-point risk in the S&Ps is the optimum distance you must let the market trade against your edge to tell you it is not worth staying in the position, then leave it at 3 points. Change this variable only if it is warranted from a technical analysis perspective. If you have done everything possible to reduce your position size and find that you're still aren't comfortable with the accumulated dollar value of losing on all 20 trades, then I suggest you do the exercise with a simulated brokerage service. Okay. So here the author is telling that, you do the back testing and ensure that you're not burning up burning your account. If you're still not comfortable, author is telling that, go with a paper trade. With a simulated brokerage service, everything about the process of putting on and taking off trades, including fills and brokerage statements, is exactly the same as with an actual brokerage firm, except that the trades are not actually entered into the market. As a result, you don't actually have any money at risk. Simulated brokerage service is an excellent tool to practice with in real time under real market conditions. It is also an excellent tool for forward testing a trading system. There may be others, but the only service of this nature I know is of audittrack.com. So the author is telling that, if you're not ready to spend that money, go with the paper trading. Doing the exercise, when you have a set of variables that conforms to the specifications described, you know exactly what each trade is going to cost to find out if it is going to work. If you have a plan for taking profits and you know what you can expect as a win-loss ratio for your sample size, then you are ready to begin the exercise. Okay, the rules are simple. Trade your system exactly as you have designed it. This means you have to commit yourself to trading at least the next 20 occurrences of your edge. Not just the next trade or the next couple of trades, but all 20, no matter what. You cannot deviate, use, or be influenced by any other extraneous factors or change the variables that define your edge until you have completed a full sample size. By setting up the exercise with rigid variables that define your edge, relatively fixed odds, and a commitment to take every trade in your sample size, you have created a trading regime that duplicates how a casino operates. Why do casinos make consistent money on an event that has a random outcome? Because they know that over a series of events, the odds are in their favor. They also know that to realize the benefits of the favorable odds, they have to participate in every event. They cannot engage in a process of picking and choosing which hand of blackjack, spin of the roulette wheel, or roll of the dice they are going to participate in by trying to predict in advance the outcome of each of these individual events. If you believe in the 5 fundamental truths and you believe that trading is just a probability game, not much different from pulling the handle of a slot machine, then you will find that this exercise will be effortless. Effortless because your desire to follow through with your commitment to take every trade in your sample size and your belief in the probabilistic nature of trading will be in complete harmony. As a result, there will be no fear, resistance, or distracting thoughts. What could stop you from doing exactly what you need to do when you need to do it without reservation or hesitation? Nothing. The author is telling that, after once you have decided everything, we have to do this exercise and we have to keep trying, right? And you have to accept that all the 20 times also it might fail. So, but you have to, the 5 fundamental truths which we learned earlier that you have to believe, right? So what are the 5 fundamental truths? There is anything can happen, right? And you don't need to know what is going to happen next to make money. An edge is just a probability. You just have, if you think something is going to work, it's just an edge. And there is a random distribution between winning and losing. And the final one is every moment in the market is unique. So all these 5 fundamental truths, if we believe, and we'll know that it is a probability game. And so what will happen? It is just we are going to keep on doing again and again and again, right? On the other hand, if it has not already occurred to you, this exercise is going to create a head-on collision between your desire to think objectively in probabilities and all the forces inside you that are in conflict with this desire. The amount of difficulty you have in doing this exercise will be in direct proportion to the degree to which these conflicts exist. So one degree or another, you will experience the exact opposite of what I described in the previous paragraph. Don't be surprised if you find your first couple of attempts at doing this exercise virtually impossible. Okay, so author is telling that this is going to fight with our beliefs, right? There will be a lot of difficulty. It might sound simple, might sound that this exercise is simple, but actually it is going to be very difficult, right? And the first few times when we do this, we will actually be, what is it called? Conflicting. We'll find it very difficult. So especially the consistent trading, the 7 points which we said, which we saw in the previous things. What are the 7 points? Yeah, so I will objectively define my edges. I will predefine the risk. It's very difficult. It's going to be very difficult because we don't predefine the risk, and you completely accept the risk. If it is going to make you loss, accept the risk. And if it is an edge, is basically you are going to go without any reservation. And whenever you get make money, keep as he said in the later chapter, do a pyramiding, like exit 25% first, and then exit next 25% next, and then finally you let the other things keep on making you money. And finally, this one, I continually monitor my susceptibility for making errors. So, you know, um, and then finally you understand the absolute necessity of these principles of consistent success. So you keep on monitoring yourself, and then you also understand that these 6 principles are very important for you to consistently be successful, right? So these 7 points you have to keep making, and it is going to be very difficult because our original belief will actually conflict with these particular things. Now, how should you handle these conflicts? Monitor yourself and use the technique of self-discipline to refocus on your objective. Write down the 5 fundamental truths and the 7 principles of consistency and keep them in front of you all times when you're trading. Repeat them to yourself frequently with conviction. Okay. So these 5 fundamental truths and the 7 principles of consistency, the author is asking us to, you know, take a printout or whatever, write it down and keep it in front of us every day before we take a trade. Okay. And every time we start a trade, we have to tell to ourselves with conviction. So, and every time you notice that you are thinking, saying, or doing something that is inconsistent with these truths or principles, acknowledge the conflict. Don't try to deny the existence of these conflicting forces. They are simply parts of your psyche that are arguing for their versions of the truth. Okay. So whenever you are going to deviate from this, acknowledge that you have deviated, and you know, uh, and look at it without any criticism. Acknowledge that, yeah, it was you are deviating. Okay. So when this happens, refocus on exactly what you're trying to accomplish. Okay. So when you are deviating, the author is now asking you to bring that concept of self-discipline, gently push the energy from that to this. If your purpose is to think objectively, disrupt the association process, step through your fears of being wrong, losing money, missing out, and leaving money on the table, okay, then you will know exactly what you need to do. Okay. So when you're objectively thinking, you will obviously you will disrupt the association processes. What are all the things you will associate? So you will basically try to, being wrong. You don't want to be wrong. You will associate with that. You will lose money. You don't want to lose money. You associate. You will miss out and you're leaving money on the table, right? Follow the rules of your trading regime as best as you can. Doing exactly what your rules call for while focused on the 5 fundamental rules will eventually resolve all your conflicts about the true nature of trading. Okay. So these 5 fundamental truths and the 7 principles, we have to keep, focused. Every time you actually do something that confirms with one of the 5 fundamental truths, you'll be drawing energy out of the conflicting beliefs and adding energy to a belief in probabilities and in your ability to produce consistent results. Eventually, your new beliefs will become so powerful that it will take no conscious effort on your part to think and act in a way that is consistent with your objectives. You will know for sure that thinking in probabilities is a functioning part of your identity when you will be able to throw one sample size of at least 20 or more trades without any difficulty, resistance, or conflicting thoughts, distracting you from doing exactly what your mechanical system calls for. Then and only then you will be ready to move into the more advanced subjective or intuitive stages of trading. So every time you take a trade, you have to write down the 5 fundamental truths and the 7 principles of consistency and draw energy from that. Okay. And shift your belief from your conflicting beliefs to this kind of belief. And what will happen is over a particular period of time, we'll become so powerful that this will how you will start thinking. Okay. So, and you will know for sure that thinking in probability is a functioning part of your identity when you will be able to go through one sample size of at least 20 or more trades without any difficulty, resistance, or conflicting thoughts. So after we take 20 trades, for our testing our trading system, and each and every 20 trade, if we make without any difficulty, without any resistance, without any conflicting thoughts, right? And doing what the mechanically system is telling, that is when we will be able to go to the intuitive stage of trading. Okay. So the author is telling that 20 times you have to follow whatever the system you are agreeing without mechanically, without anything. If it says this, that, or that, just go in, go out. That's it. A final note, try not to prejudge how long it will take before you can get at least one sample size of trades following your plan without deviation, distracting thoughts, or hesitation to act. So the author is telling that you have to do 20 times at least once successfully. So there will be time when you will, 2 times you will do, the third time we will fail. Then we have to reset, start again. So now when it will end, don't judge. That is what author is telling. Don't tell that, how long it is going to take. Oh, what will happen after the third time I will fail. And again, another 20. The author is telling, don't judge it. Okay. Just try to follow the plan. Okay. Follow your plan without deviation, distracting thoughts, or hesitation to act. It will take as long as it takes. If you wanted to be a professional golfer, it wouldn't be unusual to dedicate yourself to hitting 10,000 or more golf balls until the precise combination of movements in your swing were so ingrained in your muscle memory that you no longer had to think about it consciously. When you are out there hitting those golf balls, you aren't playing an actual game against someone or winning the big tournament. You do it because you believe that skill acquisition and practice will help you win. Learning to be a consistent winner as a trader is not any different. I wish you great prosperity and would say good luck, but you really won't need luck if you work at acquiring the appropriate skills. So the author is telling that, when you are playing a golf ball, you actually not, when you're, practicing, you are not actually going to do, you're not doing something because you are fighting someone or winning the tournament, because we want to acquire that skill of playing the golf, so that you will win. So this is what the author is telling. So you have to learn to be a consistent winner as a trader is not any different. Just like how you have to practice some 10,000 hittings before you get that thing, even trading also takes the same effort. So one thing which we can do is reduce our position size, or we can do paper trading. So till we 20 times we are consistently making that particular amount of money, and every time we are making a trade, we have to follow this five the five fundamental rules and the 7 principles of consistency. 20 times continuously we have to do it. At that particular point of time, we will become intuitive. We'll go to the next advanced stage. So the author is telling that I don't have luck. If you acquire or if you follow whatever is mentioned, you basically don't need a luck. So with this, we end this particular book. So Trading in the Zone book complete. So far it took some 18 sessions to complete the book. So I thank you for participating in this session, and I will come up. I'll see what is the next book which we can read, and I'll let you know in the group. So thank you, Rakiti, for patiently listening all these sessions. We're consistently coming. I hope we both can consistently implement whatever is mentioned and put it into practice. Okay. So thank you once again. With this, we end today's session. And if there is any other book which we will read, I will let you know in the group. Okay. Thank you.